Hi, everybody. It's Geoff Schmidt, and I am joined by my producer, Jill, here on today's live stream. I'm really excited about this one because this is the beginning of our weekly live stream. We're going to be hosting weekly live streams from here on out on Tuesdays at 7 p.m. So this is the second week in a row that we host a live stream. Last week, we had Ari Parker from Chapter. He was basically the full 1 hour interview. It was a wonderful interview. I put a link in the description below if you want to listen to the interview. He talked about Medicare, a lot of Medicare related points, questions that came through. Chapters is an affiliate of ours. In fact, we only have 3. Chapters, one of them, and it's one that we spent a lot of time finding before we brought them on board. Like our other affiliates, we do a lot of due diligence before we bring them on board. And before we begin, the standard disclaimer here. We've got a lot of questions that have come through. We'll have more questions on the chat, and we have a lot to talk through. But because we don't know you and you don't know us, we haven't actually had a discussion about your specific situation. Take the information that we provide as educational, maybe entertainment, but it's not something that you can rely on without doing your own due diligence. So do your own due diligence.
Geoff, I just want to bring to you, someone's putting in the chat box, there's a little bit of an echo.
Oh, okay. Let me see if I can bring down the volume just a bit. Is that better? I think that's better. I brought down the volume a bit, and hopefully that takes away some of the echo.
Okay, thank you.
You're welcome. So a couple of things. One, I'm going to put up a link here for anybody that wants to write in questions from here on out. This is the official link that we use for questions for the live stream. So if you have questions that you want to send in between now or in the future, this is where you send it to livestream@holyschmidt.com. And that is our inbox. We'll take those and we'll process those along with questions that come through in the chat. Now, next, as I mentioned before, the Ari Parker interview is in the description below. It was a wonderful interview. I actually got a lot out of it, and I know a lot about Medicare, but Ari, of course, works for Chapter, and so he was able to answer some really detailed questions. So do check it out. In fact, I'm going to put up our affiliate phone number here. If you have questions about Medicare, you can give them a call. And now is a very important time because between now and December 7th, this is busy season for Medicare. In fact, on the 15th of October, everything officially kicks off and you can start making changes to your plans. But Chapter is taking calls now and discussing your options with you. So if you have questions, give them a call at 440-703-1224.
Brenda is mentioning that Ari was a great help last week, and her husband called Chapter, and they were a tremendous help. So that's so great. Thank you for telling us that, Brenda.
Yeah, thanks, Brenda. And we've heard that a lot from people, both in the emails that we got for this live stream. I think people may have misunderstood when I said we're going to start answering Medicare questions next week. That was an email we sent out to our list. We got a lot of Medicare questions this week. We'll start answering those next week. But along with those questions were comments about the Ari interview. Wonderful interview. He got in a lot of detail, and it was actually, we all got a lot out of it. So Ari, if you're watching, thank you very much for the interview. All right, I want to talk about, before we get into the questions, I want to talk about a question that came up along with a lot of the Medicare questions in the emails. There was a question about the government shutdown and its effect on Social Security. Now, there are a lot of ways to answer this question. The way that I think the question most people are asking is, how does it affect me? And I don't mean that in a me type of question, but more along the lines of, if I'm receiving Social Security, are the funds going to be there for Social Security for me to continue to receive Social Security? So the answer is yes. This is what's called an entitlement program, and entitlement programs usually get funded in government shutdowns, but certainly Social Security does, because it has a a really large amount of funding in the trust. Now, putting 2033, 2034 aside, which is most people are focused on that when the trust is due to run out of funds, today there's a lot of money in the trust. And so because of that, and the fact that it is a mandatory payment program, unlike some of the other programs out there where you do see funding cuts happening, this is not one of them. Now, having said that, there are some areas that could be affected. The first is when you start receiving your Social Security payment, there isn't somebody on the other end who calculates it every single month and then hits send and it goes out to you. It's done automatically. That's why everything continues to fund. But not everything is automatic. What's not automatic? Well, people in the field offices could be, and our reductions are happening. So services around Social Security could be delayed. And that's really important, particularly if you haven't filed for Social Security yet, but you're going to file soon. I would recommend that you file as early as possible if you know when you want to start receiving Social Security. The other element is announcements like the cost of living adjustment and other automatic determinations. An automatic determination is something that happens, it's an adjustment that happens every single year, and it's automatic, hence the name. People think that there's a lot of what's the term I'm looking for? A lot of craziness happening at the Social Security Administration because there's a lot of data that comes out and a lot of numbers are being adjusted. But really, these are adjustments that nobody really touches. It's automatic. When the cost of living adjustment comes out, that's based on the Consumer Price Index, and so are a lot of the other adjustments to Social Security. So when the Consumer Price Index is released, things like the earnings limits and things like the cost of living adjustment and a whole host of other indexed numbers come out automatically. No one is negotiating those. But you would think, based on the amount of information flow that you're getting on YouTube and media, that the gloves are off in the background and things are being hashed out all over the place. But that's not really the case. So that's the second point. That data comes out next week, by the way. And so look for the cost of living adjustment out next week, and we'll have full videos on explanations on the cost of living adjustment, what's happening to other related benefits that are reliant on the inflation number, the Consumer Price Index. So that data might be delayed, but frankly, if it's delayed a month or even 2 months, it really doesn't affect anyone because it doesn't go into effect until 2026. Might be a problem if it goes beyond that, but I think it's highly unlikely that they're even going to delay that number because it's 90% calculated already. They're waiting for the final number for the month of September, for the final inflation number for the month of September. And once that's released, they can release all of this other data. So that's a long-winded way of saying, if you're worried about not receiving your Social Security payment and you're currently receiving Social Security, unless something really unexpected happens, and you never want to say never, of course, but I would say it's highly unlikely that your Social Security payment will be affected because, frankly, it's funded and it's required. So for that one question that came in quite a few times, hopefully that's a great explanation. If it's not, then send me a note at livestream@holyschmidt.com, and I'll send you a write-up on it that you can actually spend more time with in a couple of minutes here on the channel. Okay, so that was the point that I wanted to talk about with regard to the government shutdown. Why don't we jump into the questions, Jill, and start going through those both in the chat and from the email questions that have come in.
Mute. Okay. I think I was on mute. We're still getting a little bit of echo. Just want to let you know. So we're going to start with a question from the chat box from Rob. He's asking, if a person starts drawing Social Security at 62, then later goes back to work at 70 and earns more than one of their highest 35 years previously used to calculate Social Security payment, is their Social Security payment recalculated using the new highest year?
Using the new highest year numbers. Yes, as long as you're contributing to Social Security, the payment is based on your contributions, your earnings in the year that you're making contributions. So yes, it would be unusual for the number to change drastically, to be frank, because it's your best 35 years. But within that best 35 years, you're going to have another 5, 10, or 15 years that are not so good. And so the change would be nominal in most cases, because you're talking about 1/35 of your best 35 years. But if you're making payments into Social Security, then the numbers get adjusted.
All right. Someone is asking, looking for some guidance for claiming Social Security. Which spouse should claim first? Perhaps one at 62 to bridge gap to 65?
So this goes back to the comment I made in the disclaimer, which is I don't know your specific situation. There are 2 or 3 questions in that question. Question number 1 is, if I claim my benefit and then move to a spousal benefit, what's the best strategy to do that? The second question is, how do I manage my lifestyle if I want to arbitrage, for lack of a better word, the difference in earnings between, say, or the difference in payment between myself and my spouse? How do I get the maximum income in my life? And by the way, not everybody is looking for the maximum income. There are really 4 benefits that people look for Social Security. One is the maximum payment, overall payment during their life. The other is the how to optimize the survivor benefit in case something happens. The third is to maximize the payment at a point in time. So maybe what you're worried about is you have a lifestyle that you want, a certain lifestyle that you want while you still have energy. So you want more in the earlier years of retirement. You're willing to forego the later years of retirement. Maybe you have an inheritance coming in, I'm not sure, but there you would make that decision. And then the fourth is you just need the money. And I'm going to get to answer your question in just a moment, but this is so important because in the course that we just released called Social Security Simplified, we had the opportunity to interview what we call the beta group. And this is a group of 29 people that helped us correct minor and a few times major learning issues in the course and just make it really awesome. But along the way, we had something called a debrief. And in that debrief, we talked to everybody about their specific situation. And it's fascinating, sometimes heartbreaking, but fascinating when you talk with somebody about their life. And a lot of the Social Security videos that we're putting out from this point forward are based on those conversations, because these are real people that bared their soul to some degree about their specific situation. And the interplay between that and the topics, like the one we're talking about here, is so much more personal, so much more real when you actually have somebody who's attached to it. So the answer to your question is, it depends on what you're trying to optimize. If you're trying to optimize the maximum benefit for you and your spouse combined, that's math. And there are personal financial planning softwares out there. Bolden is a great one. That's our other affiliate, by the way. If you want to check out Bolden. They'll give you 2 weeks free. Just go to go.bolden.com/Schmidt, and then you'll get 2 weeks free, and it'll help you with the answer to that question about how to maximize the payment given your specific situation. And you almost need financial planning software to answer that question, because it takes a lot of information and it gives you data. Is it perfect? Nothing's perfect, but it's pretty good. I personally use Bolden. So if the answer to your question is you want to maximize the amount of income, combined income, that you and your partner receive over your lifetime, it's not a quick question. There's an answer, but it's a mathematical question. If the question is, I want to protect my spouse, and I want to make sure that he or she gets the maximum spousal benefit, well, that would lean towards the person who has the biggest concern, which is also probably the person who has the highest income in most cases, or many cases anyway, waiting longer. Because the longer you wait for the spousal benefit, the longer you wait for your own benefit, the higher the survivor benefit becomes. So yeah, that's the answer to the second question. The answer to the third question is, if you're just trying to maximize your lifestyle today, and you have the inheritance coming in, you know it's there, it's guaranteed. If there's anything guaranteed in this life, then you have some really easy choices, which is, you'll probably lean towards taking it earlier, both of you taking it earlier. If you just need the money, well, then that one would be one that I'd have to talk to you about very specifically. It's not an unusual situation. It's a very valid argument. I just need the money, and therefore I'm going to take it earlier versus later. But there are some drawbacks, because usually in that situation, things don't get better without a bit of work. And in that situation, you will need to plan for the future, which might mean that somebody needs to work a little bit longer so that you can build some a nest egg, build some safety net, build something to protect you when life happens, because life always happens, unfortunately. All right. Sorry about that. I went long on a question I could have answered in 60 seconds, but I wanted to make sure that I got that out there.
Love to have some detail. I'm sure others can relate. Keith is asking, I want to retire at 62. Does my 401k withdrawals count towards the 24k I can make?
No, they don't. Any retirement accounts don't count towards earnings. The only thing that counts towards earnings are earnings, meaning earnings from self-employment or earnings from being employed. But let's just say that you somehow managed to. I knew a guy. I don't know why he told me this, number one, and I don't know how he did it, number two. But he had something like $5 million in his IRA, and it was just a bunch of 401k rollovers. And I don't know, maybe he just hit it right. I'm not sure. But he said, so let me see if I've got this straight. If I take out $1 million a year for the next 5 years, I'm not going to have to give back any money to the Social Security Administration. I said, that's correct. However, you will pay taxes on your Social Security, because taxes on Social Security that's a different question than whether you have to give part of your Social Security back or not. And we'll, at some point in tonight's live stream, we're going to talk about taxes on Social Security, I'm sure. But in terms of the give back, it's based on earned income, either through an employer or your own job, your own company.
Okay, we have a question from Paperologist.
Cool.
My husband took Social Security at 62. He's 14 years older than me. I turned 62 this year. Going forward, my Social Security is going to be higher. If he passes first, do I get any of his Social Security?
So the question, Paperologist is 62, her husband's 76. And is that right?
My husband took Social Security at 62. He is 14 years older than me.
And she's 62 now.
Yes.
So that makes him 76. And she's saying that her Social Security payment is higher than his, even after 14 years. It's unlikely. It's unlikely because the survivor benefit is based on the earnings of the deceased. And if the earnings of the deceased are lower than your earnings, well, the only way that might work out, and this is a very special provision within the survivor benefit, the only way that might work out is there is an option, and it is one of those, you just got to squint and say the Social Security Administration just did this, or so the government just did this because they wanted to be nice. And it doesn't happen very often, by the way, when you're talking about benefits. But when it comes to survivor benefit, you can squint a couple of times and say, I know that somebody somewhere probably was rounding up instead of rounding down in that decision. But basically, you can either take your benefit or you can take the survivor benefit, but you can't take both. However, you can take the survivor benefit and let your benefit grow. And so if you were to take the survivor benefit and you let your benefit grow, you can let your benefit grow all the way up to age 70. The reverse is not true. So if you take your benefit and you let the survivor benefit grow, you can let that grow until your own full retirement age. That's age 67 for most people, and then it stops. And so because of that, you need to understand which path you want to take. And we're going to get into this in just a couple of minutes because I saw one of the questions that came through from the write-in, but I'm going to preempt it a bit and say the survivor benefit is two calculations. Calculation number one is what was the deceased earning, or what would they have been earning when they passed. And if they passed early, then they just get the amount that they would have received at full retirement age. Calculation number two is how young is the survivor when he or she claims the survivor benefit, because there's a haircut. If you claim the survivor benefit at age 62, it's going to be less than if you claim it at age 63 or 64 or 65 or 66 or 67, with the exception of a provision called the widow's limit, which is a very specific and very narrow point, which we've covered off a lot of times on this live stream, and I actually have a video on it. But if you want more information, just go to my channel and do a search for the word widow's limit. But except for that, the older the survivor, up until full retirement age, the higher the percentage they get of the deceased Social Security payment, up to 100%. So if they claim it at age 62, for example, they will get it 79.6% of the survivor benefit. But if they claim it at age 67, they'll get 100% of the deceased payment. Just order of magnitude what we're talking about here. Again, probably more information than you wanted to know, but understand that it's the age of the survivor that determines whether there's an additional haircut or not.
All right, so we're going to mix in some of the questions that came in through email that you had asked for as well. We have a lot coming in the chat box as well. So everyone, we're going to try to get to as many questions as we can. Okay, so here's a question. I called Social Security in March 2025 to file for benefits effective March 2025. I was quoted the benefit amount effective January and also the benefit amount effective March. Since it was $50 more, I elected to start collecting starting with March. However, my monthly benefit amount is the January amount. All attempts to reach someone via phone and in writing went unanswered. Will my higher benefit amounts be paid retroactively come January 2026?
So yes, well, sorry, they'll be paid retroactively because you waited the extra 2 months. They can't not give it to you even because you waited. So as I mentioned before, the longer you wait, the higher your payment. It goes for the survivor benefit and it goes for your own benefit as well. Whether that happens in January of 2026 or not will depend on a couple of things. The first is, as we all know, the SSA has been understaffed as some changes have been rolled through. And because of that, a lot of things have slipped. Now, it appears that some of them are unslipping, but whether everything is fixed by January 2026 or not, who knows? But what you can count on is that you waited, you didn't take it in January, you took it in March, and you are due an increase in the size of your Social Security payment. That will happen. Now, you have to be diligent on this point and follow up with the SSA. It's very hard right now, and it's especially hard right now, even harder than normal given staffing issues. But the great thing about life is that things change reasonably quickly in hindsight. And if it doesn't increase in January 2026, at least you can be comfortable in the fact that it's owed to you and continue to pursue it with the SSA. And eventually you'll get there.
Okay, great. Next question. The higher earner dies at 62, having not taken benefits. The lower earner is 4 years younger. Can lower earner take their benefit at 62 and then switch to survivor benefit at their full retirement age? Or does lower earner forfeit survivor benefit by claiming their own benefit early?
So this is the question that I was talking about earlier. You can choose either your benefit or you can choose the survivor benefit, and the option is simple. If you want one to grow, and it's all about optimizing the payment, well, then you really look at what you have coming in and the size that other option is going to be if you let it grow. But remember that the survivor benefit will not grow past your own full retirement age, whereas your own benefit will. And so that's something to consider when you're thinking about this calculation. The other point which isn't asked here, but it actually should be asked, is if your partner passed away at age 62 and they had not filed for Social Security, then the amount that is being the basis for your haircut, filing early or up to your own full retirement age, is 100%. So they give you credit, they'll give your partner credit for having filed at full retirement age, even though they passed away at age 62. Beyond full retirement age, if the spouse still hadn't filed, let's say that they passed away at 68, well, the date of passing is the date that they will have deemed to have been filed. So they'll get the benefit of waiting the extra year, even though they haven't filed. So it's asymmetric. You get the benefit of the upside if they pass beyond their full retirement age, but you don't have the penalty of the downside if they pass away before full retirement age. The only factor here in this situation is the age of the surviving spouse. If the surviving spouse files for their benefit, the survivor benefit, at age 62, that's 79.6%. And you can actually file up until age 70, but it stops growing at age 67. So you have no benefit by waiting to file for the survivor benefit beyond age 67. You're leaving money on the table. So it's really a question of how the math works out for you.
Okay, Robert is asking, my wife claimed deceased husband's Social Security for past 5 years. Wants to switch to her Social Security at age 70 on 2/1/26. How many months prior should she contact SSA to assure the switch occurs properly?
4 months. 4 months is the maximum time, and I would take the 4 months, especially now. And so that would be right now, definitely right now. So I'd call them today, or actually a little late to that, but get a hold of them tomorrow. Go online, file the paperwork, but I would do it ASAP.
All right. Cheat Sheet is asking, should I draw from 401k or take Social Security earlier and leave my 401k to be inherited in general? What do you think? Sorry, I know this will depend on how much I already have.
It depends on how much you have. It depends on a lot of different things. The variation of this question is something that puts a right in, but you have a couple of things to think about here. There you will reach a point where you can't just keep your 401k outstanding without drawing down from it. There are requirements. It's called a required minimum distribution, and it's either 73 or 75 for most people. So if your intent is to just let it grow indefinitely, you're going to get caught out when you hit the specific age, or you're going to get a huge penalty. That's why people don't get caught out, because the penalty is something like 25% of what you were supposed to take. It's actually a huge number. And so the answer is watch out for the RMD. Is the answer. Now, the actual question about whether you draw Social Security and let your 401k grow or not is really dependent on so many different factors. Do you have another source of income? Do you have a pension? Do you have investments that you can live on? Are your investments that you can live on coming from your 401k, or are they coming from another source? Property, for example, rental income. There's so many answers to this question, but generally speaking, and by the way, I'll tell you a secret when it comes to a lot of these questions. A lot of times people already know the answer to the question, they just don't know what the question is. So here, a possible question is, what do you want to accomplish? Or do you have the funds to if you could actually let that 401k ride, do you have the funds to live off of that? And now that you know that you have an RMD coming in your 70s, how does that change the equation for you? And so, unfortunately, the answer is it depends, but those are the parameters of things you need to think about.
All right, next question is probably one that's on a lot of people's minds. Should I take Social Security at 62 and invest it, or wait until 70?
And so this is the sister question to the one that we just asked. And so this actually, people get very, very specific in terms of their responses when I say this. So if you are going to take Social Security and invest it, how are you going to live? If you have a pension, then you can let your investments continue to grow. If you have other sources of income that are not investable assets, like property, for example, property income, then that's also interesting. But when you start thinking about taking Social Security early to invest, if the other side of the equation is, but then I need to fund my life with investments, then it becomes almost a circular activity. The and people will swear by this, but when you actually think it through, it oftentimes doesn't make a lot of sense. And the reason is because the growth in the Social Security payment. And Social Security grows at a fairly large clip from age 62 to age 70. Now, if you look at Social Security, and almost everybody, and this is never talked about in the literature, because people look at this issue only from one way, which is it's a percentage of full retirement age. But if you're sitting at full retirement age and you get 100% of your Social Security payment, then you look back and say, but if I took it at 62, I would only get 70% of my Social Security payment. That's true if you're at full retirement age. But if this were any other discussion, except for what's your Social Security payment at full retirement age, that growth from age 62 to age 70 would be about 42%. Now, let me explain what I'm talking about. If you wait from age 62 to age 63, you, assuming your full retirement age is age 67, you get 70% of your Social Security payment at age 62, your full retirement age payment, or you get 75% at age 63. Most people will say that's a 5% increase. That's not a 5% increase. That's a 7-point-something% increase, because $70 or 70% is the base. So you're going from 70 to 75. Just divide 75 by 70, and it'll come out to something like 1 point, or it'll come out to something like 7.2%, I believe. But because everybody's benchmarking their growth off of full retirement age, everybody's saying, well, that's a 5% increase. Now, when you start thinking about the fact that it's a 7.2% increase, that makes things a lot different, because now all of a sudden this is a government increase, government guaranteed increase, and it's backed by the full faith and credit of the U.S. government, and that's 7.2% growth. Well, that growth is a lot different. And you can do the same equation from 63 to 64, which is 75 to 80%. It's about 6.9%. And then 64 to 65, you go from 80% of full retirement age to 86.66%. And it gets to be like mid sevens in terms of the difference, the change year over year. So if you look at it from a slightly different perspective, which is if this were a $70 investment, not what I get at age 67, but if this was a $70 investment, it grew to $75 next year. And that $75 investment grew to $80 a year after that. And that $80 grew to 86.66% the year after that. You're talking about somewhere around 7% plus or minus. That changes things a bit. Too much information, I know, but you actually have the basis for my next video. So you'll see that out sometime in the next week or so.
All right. Rob is asking, if a person is drawing Social Security and works, say they earn $50,000 but contribute $27,000 to their 401k, equals $23,000 of taxable earnings, will my Social Security be taxable?
So your Social Security payment is taxable on adjusted gross income. Your contribution to your 401k reduces your adjusted gross income. Your withdrawal from your 401k increases your adjusted gross income. So if you are making payments to your 401k, it brings down your AGI. And so if you're talking about hitting a limit of, in 2025, of 23,400, assuming this is a non-full retirement age year, and you get it below that, then your tax, you don't have to worry about the taxes on that. But I think there are two different questions, because one is a question on taxes on Social Security, but I'm not sure if you're asking that question based on the number that you just gave, it sounds more like you're asking a question on, will I have to give part of my earnings back? If that's the case, put it back in the chat box and we'll talk about it. Okay, what's the next question?
Okay, Rod is asking, does a K-1 form income count as earned income for Social Security?
K-1, that's a partnership income. So it's a very specific question. And if you get a K-1, if you went onto your Schwab account right now, and I need to make sure that I understand the nature of the partnership, and we're going deep here. So I'm going to use the audible on this one, that if I get this wrong, it's because this is a very specific question, and you're asking the question which I want to ask back to you. Are you a limited partner or are you a managing partner? But K-1s are given to people who have income from a partnership. Most of the time, if you had a K-1, for example, on oil and gas partnership, but you were a limited partner, that would be like a dividend. But if you were managing that partnership, it would be income. So the audible is, I need to know what it is your specific situation is, with a little more detail, but a lot of times it would be considered a dividend.
Okay, so we have BR549 asking, can it ever work out for the worse if someone waits till 65 to 67 to take Social Security versus taking it 62? Or does it usually work out better for someone who's not concerned with getting the max lifetime Social Security payment?
So 2 or 3 questions in there. Question number 1 is, if you are looking to get the maximum lifetime Social Security payment, oftentimes waiting is better than not. And why is that? Well, because your payment goes up, and the tables that were put in place, the mortality tables that were put in place, which determine basically the concept of break even, which is it shouldn't matter if you take it at 62 versus 65 versus 67, were put in place in 1983. And if you look at the lifespan in 1983 versus 2025, well, it's gone up. And I think I used an example in a recent conversation that I'm not even sure that the warning labels on the smoking warning labels talked about the very specific, the really nasty things that are on there now. Back in 1983, things have changed that much, and I'm pretty confident. In fact, I'm highly confident that the average lifespan has gone up since 1983. So point number 1, going from 62 to 65 generally favors the outcome, but it's no guarantee. We're not guaranteed tomorrow. Unfortunately, there's so many shocking outcomes. Really, there's a YouTuber that is in this realm of retirement education and passed away suddenly, just really a couple of weeks ago. It was actually really sad, because I love the channel. Number 1, personally, I love the channel, but it was a family, and then the husband passed away, and it was just a shock. So that is the wild card, which is nobody's guaranteed tomorrow. However, the math, if you're just talking about straight math, and you're talking about averages and ignoring your specific situation, which you shouldn't do, by the way, your specific situation, your specific health circumstances. I just said the general population, you're going to go into this blind. Am I better off waiting, or am I better off taking it early if I want to maximize Social Security, the amount that I have coming in? There was a study done at the University of Michigan, and it suggested that if you wait, most of the time anyway, you're going to end up with something like $110,000 more income during your lifetime, the longer you wait up to a certain point. But that same study also said, except for, and there were certain circumstances where it actually made more sense. But you got to factor in your health. You got to talk to your doctor. You got to look at your family And you got to know that nothing's guaranteed. And if you think about those 4 points, framing the question again, you'll probably come to the right answer. Framing the data anyway.
Okay, Scott is asking, will removing 4 years of zero help my 35 years?
Yes. Depends on how much you remove it by. If you remove it by, a few $1,000s, it's not going to help much. But assuming your question is, okay, and most people are like this. They're at their peak earning on the back half of their career, certainly in the back 20%. And if your first half of your 35 years was small, your middle half or your middle-ish from say half to 2/3 of the way through was medium, and then your big years are the biggest earning years, I think you'll see a reasonably large movement or a noticeable movement in the size of your Social Security payment. If you earn consistently throughout that 35-year period, it would be less so. So I think you need to just basically take out a piece of paper, actually take out an Excel spreadsheet, and look up my video on bend points, and you can actually determine this pretty easily. And you can actually figure out what an additional 4 years of earnings at peak would do to your numbers. For most people, they would see a difference. But the biggest change, if you think about the influencers, is the size of your payment. Earnings is big. The number of earnings is bigger, and waiting usually is the biggest. So to go from 70% to 75%, $70 to $75, as I explained earlier, that's a 7.2%-ish increase by waiting 1 year. That's going to have a bigger impact in most cases than one additional year of work. Although the two do kind of go hand in hand, because if you're working longer, you're not drawing Social Security. So then you have a double benefit. And you do it 2 years, you do it 3 years, you do it 4 years, and all of a sudden you're looking at a pretty big game-changing outcome, because you're removing zeros, you are defraying, taking your Social Security payment, and you're putting in your highest earning years, all things being equal.
All right. DB Douglas asks, does the SSA use all of the top 35 years, including after age 60? I'm still working at age 61 with no plans to quit.
Yeah, so there's a lot of confusion. The answer is yes, but there's a lot of confusion about this point, because a lot of people don't realize this, but the cost of living adjustment isn't the only inflation adjustment that's made to your earnings. There's also an adjustment based on basically a pool of earners out there. And if that pool of earners, if I was a construction worker in 2025 and I was making, say, $75,000 a year building houses, and I was a construction worker in 1983 building houses, I might be making $20,000 a year. And I'm just making up the numbers, but order of erection, it's about 3x, just over 3x, that span of time. That difference is based on a pool of data. What's the average earnings for a group of people in 1983 versus that same group of people in 2025. Your 35 years of earnings is based on an inflation adjusted number. So your 1983 number at 20,000 and your 2025 number at 75,000 could be identical in terms of the multiplication for your earnings. But that 3x multiplier from your 83 number stops when you reach age 60. So from that point forward, it's 1x. It's always 1x. But what takes over, whether you actually earn, whether you actually take it or not, is the cost of living adjustment. So your historical earnings are set, calculated at age 62, and then additional earnings are put on top of that. But all of that is adjusted whether you take Social Security or not based on the cost of living adjustment. You can have cost of living adjustment on your undrawn Social Security payment, and that becomes the determiner of the size of your future payment, because everything from that point forward is not inflation adjusted from history. It's always a 1x adjustment. So your 83 number might be 3.2x. I actually think that's probably pretty close. So your 20,000 is multiplied times 3.2, and you end up like something like 66,000. But once you hit 60, it's always multiplied times 1. But that entire pool is then adjusted with the cost of living adjustment when you hit 62 and beyond. So you take your best 35 years, disregard the rest, and then all of that is multiplied by the COLA.
Talking about COLA, Carl's asking, is the upcoming COLA for the current year included in the index factors for those who have had significant current year wages?
I think I just answered that question differently, but it depends on your age, and if you're 60 and above, then you get 62 and above, you get the COLA adjustment on your wages. 60 and below, you don't. You get the earnings adjustment, the wage index adjustment.
Okay, Mary's asking, spouse was employed when passed in 2022. Called SSA, they told me to collect mine at age 62. He also signed me up for spousal benefits that start 66 and 6 months. Should I take the benefit now? I'm 66 and 6 months.
Sorry, I want to get back to that question in a second. Just to be super clear on the last point, you do get the wage index factor up to age 69, and 61 and above, you don't. So 60 and 61, it's a 1x, and then COLA kicks in at 62. Sorry, would you mind repeating that question one more time? I don't think I was clear on that answer. I want to make sure that I got a little bit more granular on the detail.
Okay, yeah, of course. Mary's asking, spouse was employed when they passed in 2022. Called SSA, they told me to collect mine at age 62. He also signed me up for spousal benefits that start at 66 and 6 months. Should I take the benefits now that I'm 66 and 6 months?
Okay, so if I understand the question, their partner passed away. Is that right?
Passed away in 2022, and Social Security Administration told them to collect hers at age 62.
Okay, so the spousal benefit isn't available if your partner's passed. The survivor benefit is available, and so the question might be, should I take my benefit or the survivor benefit? And that really depends on some of the factors we talked about earlier: your age, whether you want to let your benefit grow, whether you want to let the survivor benefit grow, understanding that the survivor benefit stops growing once you reach full retirement age, but your own benefit does not. And you need to really put them side by side and see which is best for you. The survivor benefit and your own benefit, unlike the spousal benefit, which has a haircut, if you take the spousal benefit and then later switch to your own benefit and vice versa, the survivor benefit usually has a haircut anyway. The survivor benefit and your own benefit don't actually get reduced by if you take one and then switch to the other.
Okay, let's take one that was emailed in.
Sure.
This one says, we each took Social Security at full retirement age of 66. He took his Social Security, and when I reached 66, I drew spousal benefits on his earnings, roughly $1,000 per month for 4 years, while I was able to let my Social Security on my earnings grow for 4 years at 8% per year. My question was just, if I were to pass away first, would he get to choose between his Social Security payment and my payment after the 4 years of growth to age 70? My payment was a bit more than his due to the provision that it will grow.
Yep. So I need to explain the concept of dual entitlement here. Dual entitlement is a provision within the Social Security Code that says if you qualify for two benefits, a spousal benefit and your own benefit, then you will have deemed to have filed for both, and you get the higher of the two. Now, a lot of times you don't qualify for the spousal benefit because your partner hasn't filed for his or her primary insurance amount, and you can't get the spousal benefit until your partner files. So what ends up happening is start receiving your own Social Security payment, and then when your partner files, you get the spousal benefit. Now, what happens in there is that when you file for your benefit, let's just say you file for your benefit, and this is approximate because there's a different speed between the spousal benefit and your own benefit, slightly different speed. I'll talk about in a minute. When you file for your own Social Security payment, you lock in a portion of your overall payment when the spousal benefit becomes available. And so let's say you filed for your own Social Security payment at age 62, and then you let the spousal benefit grow until age 67. And then you switch and at age 67, your husband or wife filed for their own benefit, and therefore you qualify for the spousal benefit. Well, that portion of your spousal benefit is already locked in at the earlier age. The only thing that grows now is the excess, and this is approximate. Because if they do increase at different speeds. Your own primary insurance amount at age 62 is 70% of what you would receive at full retirement age. The spousal benefit is 65% of the spousal benefit you'd receive if you waited till full retirement age. So you can see that there's a bit of a timing difference in there, but just know that once you lock in a portion of your payment because of dual entitlement, that piece stops growing, and the only thing that grows beyond that is the excess. So that's actually a point that needs super clarification point. So the question, would you mind repeating the question one more time? And I know we're almost out of time.
We are, and this has moved. This is the one, spouse was employed when passed in 2022. And she did put in a correction that she meant survivor benefit, not spousal benefit. Spouse was employed when passed in 22, called Social Security. They told me to collect mine at age 62. He also signed me up for survivor benefits that start at 66 and 6 months. Should I take the benefits now? I'm 66 and 6 months.
You need to think about what we talked about in terms of your specific situation is going to be dependent on what happens with one benefit versus the other, and is there a huge benefit to switch from one to the other? If your benefit, for example, is higher than the survivor benefit, you wouldn't want to do that, of course. If the survivor benefit is higher, well, the maximum size you will get for the survivor benefit is when you reach full retirement age. And based on what you said, your full retirement age is age 66, or maybe 66 in 10 months. I'm not sure what the actual number is, but once you reach full retirement age, your survivor benefit won't grow any longer. And so that's probably what they were talking about, the SSA.
So we are reaching the top of the hour. Just a thought-provoking question. Someone would love your opinion. Just be on, do you think Congress will fix Social Security, or will we all get a big haircut in 7 or 8 years? Good one to wind up the evening with.
Just put the spotlight right on the elephant in the room. So nobody's guaranteed tomorrow. I keep saying that, but I want you to picture this for a moment. And there's precedence to this. Imagine that things didn't get fixed, and there is, we fast forward, it's 2033 or 2034, depending on which report you write, and you suddenly have 57 million people who lose a significant portion, 20 to 30% of their Social Security payment. The knock-on effect with a large portion of those people is they're calling up their kids saying, "Hey, I'm moving in with you." Now, I'm being a bit facetious on this point, but you do have the real issue that all of a sudden you've created created havoc in the system, and there are going to be a lot of unhappy retirees and their family members. And so all you need to do is go back in time to 1983 to see something very similar that played out. In 1983, the trust was 2 months away from running out of money. 2 months. 2 more payments, and they would have gone to money in, money out. And because things were getting dire, or when things were getting dire, Congress acted together, and they basically did 2 things. One, they raised the contribution to Social Security by less than 1% for both the employee and the employer. And then they gradually raised full retirement age, starting about 20 years in the future. The immediate raise of the Social Security tax solved the problem of funding. And the pause, or the 20-year forward look on the raising of full retirement age, fixed the problem for the future. So I'd be shocked if the world didn't, that group of people would suddenly let all of the voters, 57 million of them, and their families have to deal with the situation. Because in the past, it was painful ish. It was a lot of people were annoyed that they had to pay an extra 0.8%. I believe that was the number. But it was a lot less painful than having to deal with the fact that all of a sudden you got a big population of people that can no longer afford life. So if you're asking for my opinion, Geoff Schmidt's opinion, I think it's unlikely that this is going to go to money in, money out. I think there's been enough major changes to Social Security, and this is the 1983 change was just one of them. If you go back in time, you'll see a lot of major changes. I think something like 13 of them since the Social Security Act was enacted. So I think it's unlikely, but stranger things have happened. But I wouldn't lose a lot of sleep over it, is what I'm saying.
Okay, well, so thank you all so much for all your questions. There's still more to go, and we will get to them next week. And please keep putting more in. But as you wrap up, Geoff, if someone's asking just about if they have a question, where can they send that into?
So first of all, free Medicare Help, our partner, Chapter 440-703-1224. Next week is a big week. Everything begins next week, and the annual enrollment period begins. So if you have questions, and they're a wonderful organization. Like I said, we only have 3 affiliates that we work with. They're one of them. Give them a call at 440-703-1224. If you have questions, then you can send them to Livestream at holyschmidt.com, and we will work on them next week. Now, next week, we are going to work with both Social Security questions and Medicare questions, because things are changing next week in so many different ways. Because the annual enrollment period starts next week, we want to start answering Medicare questions diligently. But if you want to put your question in the queue, send it there. And the earlier the question comes in, the higher it goes in the queue. So we tried to get to as many of the email in questions as possible in working with the people that also put their questions in the chat box. Gang, I think that's it. We are beyond time, 5 minutes beyond time. In fact, sorry about that. You can go have dinner with your family now or whatever it is you want to do. But thank you for staying late with me. Jill, thank you for running the show. Our producer, she does a wonderful job and actually makes my life really easy. I'm super happy that we've got Jill bringing these questions to me, because it's much harder to do it on your own. I've tried it both ways. It just doesn't work very well on your own. Next Tuesday, 7 p.m. I will see you there. Don't forget that Ari's interview is in the description box below. It was about an hour, but it was a wonderful interview, and he answered a lot of great questions about Medicare. Gang, that's it. Why don't we wrap it up? Jill, thank you so much for being my co-pilot on this one, and we will see you next week. Take care, everybody.